Our next two speakers will be dealing with real estate as an asset class, the returns and trends. And all these factors overlap each other with respect to what Lawrence is telling you from a family's operational perspective. So our next two speakers, one is Michael Joyce, who is president of Joyce Payne Partners. And they are a fee-only comprehensive financial planning and investment management service. They have to really deal with this whole issue, how much real estate, how much stocks, how much, you got the whole spectrum of investments, and they're held responsible for it. Really a fiduciary in a certain way from a larger perspective than one is in just, if they're just focused in real estate as an asset class. The other person I get to introduce is somebody I have a very long relationship with, Bill Barnett. I've known Bill, how long have I known you, Bill?
35 years.
At least 35 years. We kind of came up the road together. Bill has been in the brokerage career since 1974. He has participated in a lot of deals. I dealt with Bill a lot in when we were assembling Innsbrook, when we assembled the Deep Run Business Center and other projects, and he has always been there and very astute insight on what I should do, because I always needed a lot of advice and I always needed somebody to tell me to slow down. Bill is a CCIM and accredited land consultant. He's involved in various boards, and again, I will just refer to the bios that you have with you. So let me welcome Michael Joyce and Bill Barnett. You need the right up.
Thank you. Thank you. And it's a pleasure to be here. Want to thank everybody for showing up. I've got quite a lot to go over, and I understand I only have an hour and a half to do so. So I'll try to be somewhat brief. Actually, Sydney, I was hoping you'd be sitting on that end, so you wouldn't kick me when my time is up. So to move the audio. Oops, I'm going on. This is a really cool slide. I would give the caveat that I'm a financial analyst, so I mean I think any slide that I can put together in Bloomberg is pretty cool. I understand it's a little bit busy slide, but what we're trying to do with this is take you back 10 years. And I also think it's pretty cool I get to use a laser pointer because my 10-year-old is going to be very jealous of me with this. So we're going 10 years, so we're with some various asset classes. I'll tell you what they are, and certainly I think the slides will be available. But you know, we're going back to 2000 and 2003, so we have an upturn in various asset classes. And again, I'll go over that. And then, well, this blue one, I'll kind of go over that first, because that's really the non-real estate asset class, and that's the S&P 500. So, you know, what's kind of interesting on that is if we go to the end date of this past week, you know, we now have that as the top performing asset class over the last 10 years, which was actually even a little bit surprising to me when we put this together. But a lot of that's based on recent performance. This top one in green is an apartment index. This reddish one is Bloomberg REIT Index. This one is a Bloomberg Diversified Index, and kind of the low one here is a Hospitality Hotel Index. And we could have probably put, you know, a whole bunch more on and made this even busier and harder to follow. But again, you know, we have the rise, and you see a lot of the real estate indexes peaking in the summer of 2007 when the credit markets started to really have a hiccup at that time. The S&P 500 actually continued to rise until about February of 2008, and things started sliding down. And here you see where correlations just converge, where everything just crashes. And and that is, September 15th of '08 when Lehman Brothers went down, and massive deleveraging occurred, and everything just crashed until the first quarter of '09, and then certainly there's recovery since then. And as I pointed out, apartments, much I'm sure to Lawrence's delight, have really been the top performer of the real estate asset classes. As I said, S&P 500 making a late surge recently to just nose out apartments, and some of the other asset classes, or real estate asset classes, are really have not done as well as stocks or apartments over that period of time. Oops, I keep doing the wrong one. And I also have some slides. I'll go through some of these really quickly. These are a lot of these are from our friends at J.P. Morgan. When I was in graduate school, I learned that when you use somebody else's material, you called it benchmarking. You didn't call it using their other information. So I'm benchmarking J.P. Morgan's information. So this is the economic growth and composition of the GDP, and you see that as of right now, housing makes up 2.6% of GDP, so a rather small amount of GDP. But going into households, the home values are making up 25% of household net worth right now, and that is certainly down from where it was in the middle of the last decade, but it's still a very substantial amount. And some other things like other financial assets, pensions, deposits, other tangibles make up the other components of household assets. And you see, liabilities are substantially less than household assets, and mortgages are, make up a good portion of that. But still, mortgage, the total value of mortgage debt in the United States is actually lower than the amount of cash that households are sitting on. By some estimates, households are sitting on $8 trillion of cash right now. You also see that the debt service ratios. This is a really interesting little chart, because in the first quarter of 1980, households were spending 11.1% of their disposable personal income on debt payments. And that was a period of, that was before a recession, but a period of real high inflation. By the third quarter of 2007, when the credit markets really cracked at that time, that had risen up to 14.1%. But since then, that has just really gone down dramatically. And by the first quarter of 13, it's at 10.4%, lower than where it was in the first quarter of 1980. And this chart here in this corner just shows that a smooth progression, well, I don't want to call it smooth, but a progression upwards in household net worth until the third quarter of '07. Then of course, we had the Great Recession. But we really recovered that household net worth by the first quarter of 13. Moving on to to the corporate world, what I want to show you on here is that is this chart, the total leverage chart. This is of the companies in the Standard Poor's 500 index. This is the ratio of total debt to total equity. And you can see that on average, over the past 15 years or so, that's been 173%. But as of the end of 2012, was down to 108%. So that's really come down dramatically. This chart, talking about the aftermath of the housing bubble, you can see home prices, really flying up in the middle part of the last decade, and then come crashing down, and just a small recovery that has started to take hold more recently. Also, what's happened is monthly rent versus monthly mortgage payment. The monthly rent has been steadily increasing, but now the average monthly mortgage payment is below the average monthly rent. And that has to do a lot with what's happening in the apartment market as well as what's happening in the housing market. Home inventories, again, very low at this point in time. you know, at the lowest point since 1999. This just shows you, I mean, this is not news to anybody. We're at the lowest level of nominal and real interest rates in many, many years. I keep saying interest rates are going to go up, and eventually I'm going to be correct. I guess if you hang around long enough, you'll be right. This is a chart of what have been the best performing asset classes. The interesting point is over the past couple years and into the first quarter of this year, REITs have been really strong performers in 10, 11, 12, the top of these asset classes in the first quarter of 2013 has also been a pretty strong performer. And again, here's the stock market, you know, just showing you some values and some valuations in the stock market. Obviously, price-earnings ratios at the height of the internet bubble were sky high. Now they're, you know, relatively close to historical levels, but certainly not at the level where it was at some inflection points like the 1973-74 when it got as low as 9.5 times earnings. And then these are some of the definitions. I can make some comments about some of the things that we are looking at when we're investing in that. I might take 2 minutes to do that, and then I'll yield my time to you, Bill, and maybe we can catch up on some of that in the Q&A period. But you know, certainly we view real estate as an integral part of almost all of our clients' portfolios. We do believe in diversification. We don't want to be so diversified that we're diversified, as Peter Lynch used to say, but we do view that as being very important. There are times, except when correlations just crash together, that there's relatively low levels of correlation with real estate assets have with other assets, and we certainly take that into account in providing diversification and lower overall portfolio volatility for our clients. You know, there are some segments in the real estate market, you know, like in the apartments that have done very, very well. You know, we've certainly hit some home runs by investing in some partnerships that invest in apartments. I do love anything distressed. I mean, I love distressed debt. I love distressed real estate. I think if they made distressed ice cream, I'd probably eat distressed ice cream. I love distressed. Distressed is not quite as distressed as it used to be, but you know, we still view that there's some opportunities in the distressed markets. And some of the funds that we've invested in are doing some interesting things in the distressed markets. For example, one of the funds that we're invested in is putting up these long-term hotels for oil service workers in the Bakken Range in North Dakota, which is there's an acute shortage of housing in that area. So they're putting up. I mean, literally, some of those people are, you know, sleeping in their cars in the middle of winter in northwest North Dakota throughout the winter, and because of the acute shortage of housing. That same fund has gone into buying a lot of the so-called dirt bonds in Florida and some of the special improvement districts that were formed in Florida right before the housing crash in Florida. And those were extremely distressed at one point, so distressed that I wouldn't want to touch them with a 10-foot pole, but some of them have recovered over that period of time. But I guess the point is I do love distressed. Did I say that before? At this point, I have run out of my 90 minutes, so I'll let you go, Bill. Thanks.
We're going to have Bill now, but I just want to let you know that I'm not convinced that we're not setting ourselves up for another downturn. I'm not convinced. I see all the signals, but yet I see in the larger horizon issues dealing with the regulatory environment. I see the issues with the deficit, the debt. I don't see that we have a handle on it. I'm real curious about that as you're going forward. I mean, I've seen we've had such a trough that we've come out with, and the signs are all good, but for some reason, I'm nervous. Anyway, Bill, you're up.
Distress. We've had enough of that. Thank you for coming. I'm delighted to be in this business despite distress. Look around this room, see the people that you know. There are a lot more across Virginia that are wonderful to work with. And while we've had wind in our face and it's been tough to create value, we love to create value when it's appropriate for our clients and customers. With that thought, if I'm working this clicker right, I'm going to talk about asset class return. We're going to use a plain vanilla rural property. We could talk about improved assets or development sites or transitional sites, those sites that are no longer rural but won't be developed in the near term. And we're just going to measure them and then talk about how to manage them. And it'll be a simplistic way to look at how to go forward with other real estate assets. So if it can be measured, it can be managed. We have gone to rural courthouses since the late 70s. This chart only begins in 1999, and picked up transactions that are arm's length, 100 plus acres in 30 counties across central Virginia. And the concept was we needed to know what transactions had occurred so we could just advise our buyers and sellers, our clients and customers about what the market is. But it really became much more of a market footprint. And you'll see in that bar graph that values in 1999 were approximately $1,100 an acre. They rose and then plateaued around $3,000 an acre and then began to decline. It really was a precipitous drop for rural property. It lost a third of the value. And so in 2011, it bottomed under $2,000 an acre. We bring good news. It's a small increase, about 4%, but we've actually seen the value of rural property increase on an average, that is 100 plus acres, rural counties, no water and sewer, 30 around Richmond. But then we also looked at a second index of information. Again, if it can be measured, it can be managed. The number of transactions. In the good market years, we had transactions in those same 30 counties of about 250 plus or minus transactions per year. When we had the dot-com bust, it was 137. This last decline, it came down to just over 100. We're back up to a little higher than 150, so the market's beginning to recover, but it's not recovered back to the previous plateau. And frankly, maybe that's not a good thing to see that happen when you're thinking about Sydney's comments, because there's still a lot of angst in the marketplace. Okay, so you collect this information, you can use it with your buyers and your sellers, but what else can you do with it? We decided to go to a respected economist here in the Richmond area, Christine Chimera, and ask her and her firm to say, if we share this with you, can you create some kind of sense of this that gives us an explanation? And if we're really fortunate, maybe a look forward. So Chimera Economics and Analytics did just that, and they came up with a model that explained a look back over time and then a forecast going forward. So this slide represents in the gold the price per acres that you saw a couple of slides ago. And in the blue, the financial model they created. And you see a very high correlation between what actually happened and what their model explains. Okay, so much for history. What about going forward? Here's the forecast. They forecast for last year, 2012, an increase over 2011, the bottom, and then again in this year, 2013, and next year, 2014. Now, this is not a bounce. It's not a boom, but it is steady, reliable growth based on a model that's worked in the past. Now, if we have some kind of interruption of energy in the Middle East or Cyprus becomes contagion, all bets are off. But That's good news. We've had two good indicators. And importantly, for a lot of the people in this room, when I talk to them, they're sensing the same thing I am. Right here, there are more inquiries, there are more negotiations, there are more contracts pending, and in fact, more closings in other asset classes as well. So, you take that information, how do you use it? So what? In talking with my fellow brokers in the office, and by the way, I need to interrupt myself. I didn't thank the other members of our staff who looked at those sales, and then we had that kind of conversation. In this room should be, I can't tell because of the bright lights, Butch Wilberger, Butch, you out there, Hank Campbell, Sam Worley, Joe Berman, and Ryan Finelli. All these people looked at these transactions and decided, no, yes, this one's over 100, no, it's not arm's length, to come up with this database. So thank you to all those men. But then, so what when you got that information compiled and analyzed by Chimera and Associates? If you can measure it, what can you do with it? Well, you can manage that asset, but it's not just an aha moment. It is aha. If you were to take away only one thing from the real estate component of this afternoon, I'm going to suggest to you that it's probably something you've seen happening because of your business, but really grip it. And that is, the game has changed. It's not just that we've been on a downward market the last 4 or 5 years. It's not just that we have wind still in our face, albeit that wind has subsided, we hope, Sidney Gunst. It's because there's a lot more information, there's a lot more analysis, there are a lot more skill sets, there are a lot of other resources that are available. The second component of that is, it's a team sport. You may not need, for any particular asset that you have, an architect, an engineer, a land planner, civil engineer, zoning attorney, a wetland specialist, whatever it might be, but it's almost certain that you will need some specialist or specialist in order to husband those assets. They're like children. Bring them to maturity in order to analyze the particular aspects of it, because each property has its own unique cycle. Those are track level characteristics. They're not just the market characteristics. So if you go back and look at what's happened, and by golly, Michael, I'm glad my slide doesn't have the dip that you have in yours. Maybe I just stretch it out so it didn't look so bad. But at any rate, when you ride up and down, and think about it, a lot of the people in this room have been in the business or associated with it like I have for 40 years. You remember Paul Volcker, 20% interest rates. You remember the stock market crash of '87. You remember what happened before commercial-backed mortgage securities were invented in, I don't know, 1993, something like that, Lawrence, and which injected a lot of liquidity and for some time, a lot of discipline from the marketplace into real estate assets. I mean, when I got into business, they were talking about, giving liquor to the developers and how, well, you know what happened. Anyway, it worked. Then we had a hangover. All right, so you see those market fluctuations. No track necessarily has the same curve of rising and falling, the same as the marketplace. This is the marketplace, but your value might be up here or down here, depending on the individual characteristics. So it's a team sport. The game has changed. You need to look at those individual characteristics and take advantage of that. Let's go back to, well, then what do you do? I'm telling you, there still is, and this is where we really agree, Sidney, there's a lot of chaos out there. There's a lot of confusion. This is the time to play the game differently, to have a team sport, align yourself with professionals who can help you out, analyze the techniques, and the unique characteristics of any property, whether you're considering to buy it or you own it and you're wondering whether to sell it. No, keep it. So that you can see through the fog, get past the chaos, welcome the chaos. You know, generally we don't like chaos in the marketplace. We like predictable markets. We like certainty. Investment is risk averse and uncertainty averse. I'm telling you that right now we have a buying and selling opportunity. And if you go back to this slide, I mean, suppose you bought here. It doesn't feel very good to have that happen. We can talk about some of that later in the Q&A or in the break. Embrace the chaos, play the game differently, and you'll find an opportunity to move forward and make the best of whatever you have. We'll be glad to answer questions in the Q&A and, of course, to see you afterwards. Thank you very much.